Hello, my name is Vicki Hangis, and I will be presenting on banking regulation and ethics. I will begin with an introduction on the importance of a strong banking system. Banking is an industry that touches every one of us probably every day of our lives in some fashion. It is one of the largest and oldest industries in the United States. The first commercial bank was established in this country in 1781. Alexander Hamilton stated it best when he said, "Most commercial nations have found it necessary to institute banks, and they have proved it to be the happiest engines that ever were invented for advancing trade." This quote states the importance of banks many years ago and still today for economic development. Some important functions that banks provide to maintain a healthy financial system include an employment aspect. Banks are everywhere. They're large institutions that hire a lot of people. They are credit providers. If individuals had to come up with cash up front to purchase a house or businesses to purchase inventory, economic growth would be anemic at best. Lending is a key function for the banking industry. Banks are also liquidity providers. If individuals need cash, they go to the ATM. If businesses need cash, they can maintain lines of credit at banks to have cash at their disposal when needed. Banks support the functioning of financial markets through the purchase and sale of large quantities of securities. They also provide risk management services through derivatives transactions. Prior to the 1900s, there had been a series of banking crises, one occurring on average about every 8 years. In order to stabilize the banking system and the economy, the Federal Reserve Bank was established in the U.S. in 1914. Taken from European bank models that were successful, the Fed became a source of liquidity for banks that were solvent but couldn't access liquidity. Other important steps taken by the Fed to stabilize the economy included the introduction of Federal Reserve notes as currency for uniformity. In the past, each state had issued its own money, creating cross-state border difficulties. The Fed could also use tools at its disposal to control the level of interest rates, a key component. Banking regulations are increased following a crisis in an attempt to stave off a similar crisis in the future. Regulations have been relaxed once it is determined that some regulations may be detrimental to the economy and to banking competitiveness. And then another crisis hits, and regulation increases again. The banking industry is perceived as one of the most overregulated industries, with the next step in this cycle the repeal of some of the stringent regulations imposed during the most recent financial crisis. So when a banking crisis occurs, the government believes that actions should be taken to better protect the functioning of the banking system, thereby protecting consumers and businesses. Since the Fed was established, there have been two major banking crises that have spurred major banking regulations. The first was the banking crisis created by the stock market crash of 1929. Speculative investing, borrowing to purchase stocks, became a problem when stock prices tumbled and cash was needed to meet margin calls. This created a run on the banks as depositors rushed to get their money out while they still could. This led to the Great Depression, one of the darkest periods in the U.S. history. This brought about regulation, the Banking Act of 1933, also known as the Glass-Steagall Act, implemented by President Franklin D. Roosevelt. The second banking crisis occurred in 2007 as the housing market collapse led to large-scale mortgage defaults and bank illiquidity. This brought about the Dodd-Frank Act in 2010, termed the most sweeping overhaul of financial regulations since the Great Depression. Federal deposit insurance was introduced to make consumers feel safer, to let them know that there was no need to run to the bank to get their cash. The government had their backs. That is, up to $100,000, that was later increased to $250,000. The Fed took control of how much interest banks could pay on deposits. But the key aspect of the Glass-Steagall Act was the separation of commercial banking from investment banking. Commercial banking is the traditional taking of deposits to make loans, the relatively safe side of the banking business. Investment banking is riskier. Investment banks raise capital from other sources other than deposits. They also issue financial products and underwrite new issues that need to come to market. Glass-Steagall maintained bank stability from the 1930s to the 1980s. The regulation on banks was making them less competitive with other financial institutions that weren't as regulated and could be more innovative. Customers were moving cash out of bank deposits and into less regulated products, such as money market funds that were paying higher interest rates. Portions of Glass-Steagall began to be repealed to help banks become more competitive. They could set their own interest rates on deposits, and ultimately in 1999, the Gramm-Leach-Bliley Act allowed the combination of commercial banking, investment banking, and insurance company functions under one banking entity. Banks could now access capital from other sources other than deposits, and they could purchase new and different types of securities. And we know what that means: higher yielding and riskier. This leads us to the financial crisis of 2007. The repeal of Glass-Steagall had opened the door to bank consolidation, reducing the number of banks to 8,000 in 2008 from 15,000 in 1980. This created larger, more complex banking institutions that ultimately led to the largest and most important banks to be known as too big to fail. That is, if something bad happened to them, the entire financial system would collapse because they were systemically important. The Fed would have to bail them out in order to maintain a functioning financial system. Banks became involved in the derivatives markets for other than risk hedging purposes. The notional value of derivatives grew exponentially, making it difficult to assess the size and risk of these transactions. Securitized mortgages were being constructed and sold by banks as a way to package mortgages and lay them off on investors around the globe. By moving the loans off the bank's balance sheets and into securitized products, the banks reduced the impact of capital requirements on their activities. They were then able to use the cash they raised on sales of securitized debt to make more loans. Banks were able to borrow in the short-term markets using commercial paper and repurchase agreements to continue to finance longer-term loans and purchase longer-dated maturities. Borrowing short and lending long has its pitfalls if liquidity dries up. The proportion of bank revenue that was non-interest income was increasing. This indicated that bank income was coming less from traditional banking sources and more from riskier practices. The increased influence of the shadow banking system was also increasing risk in the marketplace. These non-bank financial institutions were performing bank functions without the regulation and protection that banks possessed. They could not borrow from the Fed if needed, and investor cash was not protected by insurance. Money market funds are good examples of shadow banks. During the crisis, the Fed actually stepped in to insure them as well. So here we are in the early 2000s, and the real estate market is booming, driven by the government's encouragement that every American should be a homeowner. Banks were laying off mortgage real estate risks by securitizing loans and selling them to investors, earning fees on both sides of this equation. Banks were lowering the standards on loans to keep the pipeline going. It became commonplace for banks to provide loans to individuals with no income verification and no money down. These low-quality loans were then stuffed into securitized debt obligations and sold off to customers as very safe and highly rated investments. The rating agencies, S&P and Moody's, were rating them AAA. Since the rating agencies were getting paid by the issuers to rate these securities, they were reluctant to lower the credit ratings on them because issuers would pull their business and rating agencies would lose fees. In addition, the banks wanted the rating agencies to maintain the higher ratings so the securities would still be appealing to investors. Banks and financial institutions were acting as if housing prices would go up forever. As the housing market is cyclical, a boom period is followed by bust, and in this artificially inflated real estate market, the bust was huge. As housing prices fell, refinancing was no longer possible. There was no equity value in the loans. Individuals couldn't afford the loans they had been granted. They stopped paying principal and interest, default, and then foreclosure ensued. The securitized debt that had been created and sold as high quality was now racked with non-performing loans, collateralized with foreclosed and rapidly dropping in value real estate. Short-term lenders, such as money market funds, had been consistent lenders to banks and their structured investment vehicles. The structured investment vehicles were off-bank balance sheet entities that were issuing commercial paper to purchase longer-dated securitized debt and were highly leveraged. The money market funds were no longer interested in lending to them, as they were worried about the depreciating value of the assets on the books of the borrowers. This caused a huge liquidity squeeze as the short-term liabilities were maturing. Borrowers could not raise cash to meet the maturities. Ultimately, the government had to come up with liquidity and guaranteed debt of the banks. This was expensive for taxpayers. There were several programs that the U.S. government created to make liquidity available to banks and to guarantee it in an effort to restore investor faith in the financial system. Following the financial crisis of 2007, regulation was once again in vogue as the government seems to react to crises and not take steps to prevent them. By enacting the Dodd-Frank Reform and Consumer Protection Act, the mother of all regulations, the idea was to take a more proactive stance to banking crises. The Financial Stability Oversight Council was created to identify risks that could upset the financial system and promote self-reliance. That is, for the banks not to expect that the government will always be their savior. Front and center was the increase in capital requirements, requiring banks to have more unencumbered assets on the books to cover potential losses. The Volcker Rule was put into effect, prohibiting proprietary trading, that is, trading for the bank's own account for speculative purposes. Only transactions that were tied to bank operations, such as underwriting and market making, were allowed. Derivatives activities were limited to hedging only. The sellers of securitized products were forced to retain a greater share of the credit risk so that they too had skin in the game with regard to the safety of the underlying assets. The Credit Agency Reform Act attempts to make more honest entities out of the rating agencies who are in cahoots with the banks to perpetuate the securitization scheme. Their methodologies for rating securities are now regulated by the SEC, and they are required to separate their ratings functions from their sales and marketing efforts. Dodd-Frank, in an attempt to provide undue risk-taking and relying on the Fed to bail them out, increased the risk-based capital requirements to assure that banks have enough capital available to cover losses. It also lowered acceptable leverage limits and raised liquidity requirements. The Act also requires banks to formulate their own resolution plans for coping with financial stresses, making them take responsibility for their own actions. Some believe that the repeal of Glass-Steagall allowed the banks to get too large and permitted them to take greater risks that posed a tremendous threat to the financial system. Perhaps they should have been kept to their knitting. In closing, ethical behavior will always be an issue in the banking industry unless the government regulates it out of existence. As long as there is money to be made, and that is what banks are all about, there will continue to be individuals looking for ways to line their pockets, regardless of whether their actions are ethical or unethical. We have also seen that even with a heightened regulatory environment, we are still seeing banks exhibiting unethical conduct. Recent issues surrounding Wells Fargo and the opening of phony accounts to meet sales quotas is just one example. There have been other incidents that show that banks may still be involved in proprietary trading, an element of increased risk to the financial system if these bets go against them. Adhering to regulations does not necessarily mean that a bank is operating ethically. We have seen on a very large and powerful scale how unethical behavior almost took down economies all over the world. The next move for the regulatory environment is to ease restrictions, if history is any guide. This could potentially open the door for more innovative and unethical conduct.